Rajeev, thank you for doing this and for taking a few questions for us. I hope you're safe and well. Uh, I'll come to the first question, straight away. Obviously, COVID has kind of upended our lives in many ways, the world of business. How has the Indian portfolio companies fared amidst the carnage?
Well, thank you, Bodhi. Always a pleasure. Hope to see you soon in India when I'm there, sometime in December, maybe November. Our Indian portfolio companies, let's go through. We have over 10 of them. And of course, this is still, India has been more adversely affected than other parts of the world. And we're not out of it yet. So, but our companies, for one, let's talk about the positives. Our companies, for one, are well capitalized. They all raised capital earlier this year, last year, even the large ones like Ola, Paytm, Oyo. Some are profitable, like Bodhisatva. They don't need capital. So the capital part is in good shape. And they have enough runway for the next few years without having to raise capital. If you look at the Vision Fund, which has roughly 95 companies around the world, and that same applies for India, COVID had a good unintended consequence, which was that the companies went back to the drawing board, got focused on what they should be putting their capital resources into, and cut operating costs dramatically. Which has been very good across all our 90 plus companies around the world. They looked at innovative ways to cut costs. They looked not just when you say cut costs, it's not employee costs. It's cut only. It's cutting costs by defocusing certain businesses that they were looking to expand, defocusing certain geographies in the world. If you're selling used cars, you're trying to sell new cars along with it. Let's not do new cars. Let's focus on used cars only. And if you're selling used cars, instead of going to a center to get your car tested, get it self-tested, for example, by the seller with photographs, and use AI to put a price on the car. Or whether you're selling homes, I mean, it applies to all our businesses. So I believe the operating leverage of the companies coming out of, when they come out of COVID, whenever that happens, next 6 months, 9 months, the operating leverage will be huge. Same thing happened to large public companies that we have, like Uber. They cut costs dramatically. They focused their business down. They looked at every line item. They invested in technology. And as the rides come back, their operating leverage and their profitability will improve dramatically. So, apart from hospitality, which is Oyo, most of our companies in India and outside, the world has gone online. So Grofers, Policy Bazaar, selling insurance online, delivery with overnight delivery, or Lenskart, or First Cry, all have tailwinds which are helping them dramatically.
Right. How has Oyo fared?
Your favorite question, Bodhi.
Yeah, can't help asking it.
So obviously, look, Oyo has enough capital for the next 2.5 years.
Right.
Oyo cut costs by 70%. Is investing more and more in technology. Is also rein back its focus from a lot of geographies to focus more on India, Southeast Asia, Middle East, which is core business. Holiday homes in Europe, which is another core business. And then our new joint venture in Latin America and US that we have set up with Oyo. So Oyo's operating expense used to be over 100 million a month. It's down to 30 million a month. And, with that kind of operating expense, when you're making 25, 30 million top line, it is kind of breaking even, which was not the case before.
Right.
So the good news is that Oyo is breaking even because of COVID, despite revenues being down than where it was before. Now, obviously, the negative is it's not growing as much, and that's you can't help it. Right now, it's all about batting down the hatches, focusing on your costs, focusing on how do you differentiate yourself, what is the value proposition you offer to small hotels, improving the technology, making it easier for a small business and the proposition for them to sign on, and also, of course, focusing on top line margins. So they've taken the necessary steps to weather the storm, and we're happy with this trajectory.
Right. So, just to stay with the Indian companies for a moment, I mean, India had quite a hard lockdown, which lasted a little more than 2 months from end March till about end.
Well, it's still going on. It's still not completely.
Still going on. In a sense, the nation is still in lockdown. I mean, the train services are yet to resume in a place like Bombay, so it's still going on. Yes. And yeah, as far as the hotel sector is concerned, the lockdown is very much on. So, has this, some of your, you sort of referred to this, but in the sense that has the digitization, which is obviously accelerating, has this helped some of your group companies, particularly insurance companies and companies like Grofers, because everyone is selling online, because that's often that's the only avenue available.
And it's not just India; it's everywhere in the world. So you're asking me a question: is what is the new normal? Kind of, and how long will it last? I think a lot of the changes are semi-permanent. Nothing is permanent because we all have, our memories fade. But a lot of them are semi-permanent because before it was the younger population that was going online, not the 45 plus. That has changed dramatically because people like you and me never use Zoom, which is what we are using now. People like you and me never ordered food out that much online, or would even visit a doctor online, which has dramatically increased across the world, including China. And we're seeing that in our portfolio companies, whether it's online education, whether it's online medicine, whether it's online selling of cars, or just buying of clothes, e-commerce. We have huge e-commerce assets around the world, from Alibaba to Coupang in China, in South Korea, to Tokopedia in Indonesia, etc., etc. And it's affecting the whole value chain, not just the e-commerce business, but also the logistics part of the business in a big way, like delivery. So I'm just giving you a perspective of the globe, and then comparing it to our India microcosm. The world, I don't think, goes back to the way it was before, and there'll be permanent changes, which are good for India, because like what happened to mobility in India, you skip a whole process, and big changes in education, how education is offered, which helps, in a way, or how medicine, which are the two big industries, and where income inequality has an adverse impact on the not so well-to-do in developing economies like India. That will be a positive because of technology. I think founders have more leverage in this environment, because what's happening is also not because of COVID. The public markets are buoyant across the world because of COVID, to some extent, because money is cheap. We have negative real rates to negative absolute rates in Europe, and close to zero rates in UK and US. And the Fed has basically come out and said, and the central banks, that they'll do whatever it takes to get the economy going and create employment. Inflation is not a benchmark they're worried about. So that has put a lot of capital and liquidity into public markets. So what we are seeing, which is very interesting, is the demand for private capital has gone down. Because if you are a company that is at a mid stage, a company we invested in January, I'll take a case study as always to make a point, called Beike, B-E-I-K-E, real estate broker online in China, the biggest. We invested $1.3 billion at $12 billion valuation in January this year. Today, if they want 1.3 billion, they went public at 22 billion. We invested at 12.5 billion, took a 10% stake. They went public at 22 billion last month, trading at 60 billion valuation. Why would they want private capital when the public markets are valuing them at 60 billion when they were worth 12 billion 9 months ago in the private markets? So the demand for capital, so hence us venture capitalists or private investors we are at a disadvantage versus the public markets where the valuations are a lot better. Hence, we have to differentiate ourselves as SoftBank, by bringing our ecosystem and other, benefits that we can provide to the founders from our ecosystem of nearly 100 growth stage companies, like plus Alibaba, Arm, SoftBank Corp, and help these companies. Because capital is no longer an important factor because the public markets have enough capital. I believe also the demand for private capital in the near term will come from countries like China more than the US, because the US is crowded with private capital. So industry leaders will emerge stronger because of COVID, because most of our Indian companies are emerging stronger. Coming back to India, if you're number one or two in that sector, because if you look at an Uber versus Lyft, market share before was 70-30 Uber and Lyft. I think the market share will drift dramatically in Uber's favor, and has drifted because A, they are global, B, they have the food business, eats business, which is throwing off a lot of money, and so if you're a market leader, you'll come out a lot stronger versus a lot of small participants who won't get the capital anymore. Coming back to your question, how are our Indian portfolio companies doing? They are all kind of leaders. We look at FirstCry, they're number one, and what they do, Lenskart, they're trying to digitize and go online with glasses. Delivery, they've become number one in overnight delivery, not just for e-commerce, but they're doing all logistics, for mid-sized companies, also for auto companies, for tire companies, doing supply chain management, logistics. A Policy Bazaar for online customized insurance delivery, etc. And Grofers is doing amazingly well with unit economics positive and become profitable. So the list kind of goes on. Ola, of course, given the circumstances, despite that, it's doing very well. It has a small lead over Uber in India. So a crisis creates leaders, and you'll see leaders emerge.
Just wanted to bring you to a issue which we discussed earlier. But obviously, there is given the geopolitical situation, and in particular the situation between India and China, as you're aware, India has recently banned a whole host of Chinese apps, and they're also discouraging at the national level. Chinese investment is being kind of discouraged. What are your thoughts on this phenomenon?
That's a geopolitical question, Bodhi. I'm a simple investor.
Sure.
I don't take sides.
Of course. To ask the question a different way, then, will it impact the Indian startup story?
So your question is, where is the capital going to come? Who's going to fill the vacuum?
Yeah.
Because the Chinese capital is not just capital, sir. Chinese capital also came with a lot of expertise. Alipay, it was a strategic investment. It's not a financial investment. So, Chinese capital was not just capital, sir. Chinese capital also came with a lot of expertise. Alipay, it was a strategic investment. It's not a financial investment. So, Alipay, not just, it was a strategic investment. It's not a financial investment. Uh, when we invest, there were strategic investments in our companies. There's enough capital, as I said. We will fill the vacuum. I'm not worried about that. I think what will be missed is the technical know-how that was provided by these companies, whether it's Alipay to Paytm or to the food delivery business or to Big Basket or what have you. A few $1 billion, $10, $15 billion of financial capital will be replaced. It's the technical knowledge that a ride-sharing company can get from a Chinese ride-sharing experience, etc., which will be missed. Right or wrong is not for you and me to kind of opine on. It is what it is. And the world, what's more interesting is what we're seeing across the world, because we have investments in every continent except Africa. And the world is the next frontier for any show of strength or a form of Cold War will be fought in the battleground of technological supremacy. Mark my words, for the next 10 years. It's about who has better technology. Because that is what's going to define. It's like sending man to moon with Yuri Gagarin, and it's about Kennedy. Right now, who has better chips, better medical technology? Because they're all intertwined. Your healthcare is all about gene splicing, genetic engineering. It's about providing better education online. It's about better chips. All that requires who has the more intellectual property with chip design. Creating better telecom networks, because that has a direct correlation with GDP growth. The next frontier of geopolitical conflict is not just about physical muscle and armies and so on. It's about technology superiority, and that is already started. You see that with the US and China. You see that, and you see that across the globe. That countries and nations will want become self-sufficient in technology, and that's where the power will come from. So, and US had that lead for decades, and nobody wants to be, and countries don't want to be dependent on that.
Okay, I'm being asked to ask the last question, so I'll you can answer it in whatever way. Are you looking at the two quick things? There's been some speculation, murmurs in the market that you might be interested in a stake in Reliance Retail. Is there any truth to that? And also, are you looking at any transaction involving the Indian unit of TikTok?
Look, SoftBank today is sitting on, given some of our divestment, we're sitting on more than 50 billion of cash. We have enough capital. And we're hungry to invest, because Misra's vision that technology and AI and basically technology disruption is going to change the way life is conducted, whether it's in life sciences, medical, whether it's in education, whether it's SaaS, or how food is prepared and delivered, dark kitchens, etc. Every walk of life. So we are we are continuing to invest, and that's what. If you look at our last earnings call, we said we are an investment company. We're not an operating company. Plus having sold ARM, which we just announced, for over $40 billion, we'll have more cash.
Right.
I'm not even counting that. So we are keen to invest in India. You just brought up one or two examples. Are we looking at Reliance Retail or TikTok India? Yeah, we are. We'll be. We are keen to put dollars to work in India.
Okay,
I'm avoiding your question.
Yeah, I'm not taking that as denial. Okay, are you looking, very quickly, are you looking to exit any of your Indian businesses in the near future?
No, we are ready to invest. We're not looking. We just started investing 3-4 years ago. With earnest in India. No, we're not looking to exit anywhere in the world. India's still early days. Well, we just started our office in Mumbai, a year and a half ago, and we have 20 people there. We have our solar business in India, which hasn't panned out with the same growth that we had planned. We had met with the Prime Minister and others to suggest ways where you could deploy several $1 billion into Indian solar, and we're still keen to do that under the right circumstances and policy. So no, we are not looking to exit anything. If it goes public and that the company decides, that's fine. But if you look at our exit, we invested in Alibaba in '99. We're still the largest shareholder after 20 years, 21 years, and we're still there. We're not short-term investors.
Okay, we'll wait for action on the Reliance Retail and TikTok fronts, but I'm being told that I need to wrap up. So Rajeev, once again, thank you so much for doing this.
Thank you, Bodhi. See you soon.
Look forward to meeting you in person.
See you.